Welcome to the Mint Funds and Market Update. My name is Alistair Dring, the Assistant Portfolio Manager for the Mint Diversified Funds. Please take a moment to note the disclaimer regarding this recording. I'll give you some time to have a brief read. Right. We'll start off with fixed income for the month of April. For no other reason than it's more enjoyable to finish on a positive note. Not to say that fixed income was terribly bad through the month of April, but it also was slightly more nuanced, rational for its performance and divergence in performance as well within the fixed income space. But what I wanted to highlight was, the current position of inflation and the expectation for rates going forward, which ultimately led to the performance in the month, is quite nuanced. And the word transitory for inflation was used in successive inflation shock events. And taking a look at the left-hand side of the slide there, you see since 2020, the pandemic was a supply-related shock. The world went into lockdown. There was a massive spike in inflation, and it was considered transitory at the time. Again, moving on to Russia invading Ukraine, and there was the gas supply shock, which impacted Europe largely, particularly during the winter times. That was a transitory short shock to inflation, and we had the Liberation Day tariffs. Tariffs by nature filter through to the economy in the way of increased prices in order to pay for those tariffs, and was considered potentially structural, but now we see that as something that's more transitory and is still filtering through the system because all of the reversals of those tariffs were considered unconstitutional. And then looking at Feb and March of this year, we've seen the US strike on Iran and Iran's their responsive sort of closure of the Strait of Hormuz, the impact on the oil price thereafter because of the constraints to the system, and that spiked inflation, which we're all sort of feeling at the pump more readily. Now, all of those considered transitory, they all flush through the system in varying speeds and lengths of time. But what the chart on the right is showing is that when you have these successive events back to back to back, and the different lengths of time that it takes for inflation to filter through, what you start to get is persistent inflation well above the trend. The bottom line there is the 2% trend that most central banks manage their inflation targets to, and you can see in the US, Australia, Europe, UK, and all but Japan, considerably above their trend line. New Zealand is no different, sitting much in the same position as sort of Australia and the US. And the reason I bring this up is that it sort of gives more context to the position for central banks and their potential for rate changes. Now, moving on to this next slide, yes, the short-term expectation is a short-term inflation spike and then a responsive rate change. But looking further afield, the market's pricing in through inflation swaps or CPI swaps in 5 years' time, the 5-year forward expectation of inflation is very stable and well within either the band of 2% or slightly above it at 2.5%, but stable, albeit Japan's expectation hard to predict with them trying to generate some inflation in their economy. That backdrop for fixed income has meant that rates in the short term have risen, especially in the government's space. Sovereign bond yields globally have risen, and that has been sort of a negative detractor, or has been a detractor from performance in the fixed income space. But with strong fundamentals in equity markets, strong equity market performance, and arguably The markets are pricing in a lower risk expectation or risk premium in equity markets. They're seeing more risk in the fixed income space. The credit spreads have tightened considerably, so your high yield and your investment grade bonds have performed well through the month of April. And we saw that in all fixed income components of the portfolio. So moving through to the US fundamentals part of the portfolio. Now we focus on the US here because they're going through a reporting season. There are some conversations around the US markets reporting on a biannual basis as opposed to quarterly. Now I think the function of the quarterly earnings reports does the market a solid function of giving them the information they need in order to manage expectations for themselves, but keep sentiment in check. And but what it does as well is we've seen in this quarter, the earnings season has brought about some significant numbers, all to the positive side. This is the 6th quarter of consecutive double-digit earnings per share growth. Which is considerable, and the size of that is considerable as well at 27%. Now, we have close to 90% of companies in the S&P 500 having already reported. 84% of those have beat their expectations. Now, the 5-year average for context is around 78%. So that is a sizable number of companies that have beat expectations, and it's not just concentrated in the AI tech or AI adjacent names. There is a bit more broadening of that performance, or especially around the earnings per share number. But one thing that is considerable is the capex spend from those large AI names, with the likes of Alphabet, Amazon, Microsoft, and Meta dedicating a significant 725 billion of expenditure in 2026. That's up 77% from 2025, and that alone has buoyed the market considerably as these sort of earnings have filtered through the system. But the expectation for growth in 2026-27 is looking incredibly positive, and as markets do, pricing in that. So, markets looked through the shock. There was a bumpy ride. March was a month we'd all like to forget with the volatility. April rebounded strongly with a really positive result. As markets do, they look forward. And, with that rebound, we saw the S&P, the NASDAQ, and the Nikkei all reaching all-time highs at some point in the month. But more interestingly, the likes of Taiwan and South Korea posting some massive returns for their indices. That would largely be driven by the AI and AI adjacent names, with the likes of Samsung and TSMC really pulling those indices up, and they take a fair whack of the top end of the market cap, so play a big part in the performance of those indices. But moving on locally, you'll see, in New Zealand, the NZX 50, a considerable underperformer relative to every indicator on that screen there. But there's some interesting reasons as to why. And, let's start with the sort of the inflation backdrop, because I think that informs a view of the rates, and then we'll move on to sort of why New Zealand shares performed the way they have, which is a sort of a link to the rates market. So with New Zealand CPI coming in at 3.1% for the year, it was a lot firmer than the RBNZ had expected. And the chart on the left shows that trajectory, with headline inflation sort of had been falling back towards the 1 to 3% target band, but a significant uptick. And the concerning bit here is that oil price impact has unlikely reached the CPI data yet, as it typically takes 1 to 2 quarters to actually filter through. So we're expecting to see an increase in the CPI reading, and therefore giving the central bank a particularly tough task of how do they manage that inflation spike. And naturally, their sort of best approach would be through an increase in rates. And RBNZ and the market are pricing in some significant and steady increases in rates over the next year or two. And the RBNZ's expectations versus the market, and then we have got Westpac in there as well, all indicate that there will be rate hikes to come. And that sort of scene is set up for how New Zealand markets respond. And there was a few conversations around the team here, and the interesting point that was pulled out is that the fundamentals for the New Zealand market are still quite attractive from a sort of fair value perspective. From a dividend yield perspective relative to government bonds, from a PE fair value. Some of this information's all been pulled from sort of some foresight bar literature. The market looks fundamentally in a good, strong position, but the challenge that it's faced by is that a lot of the names within the New Zealand sector, which is different to the ASX 200, are these defensive yield stocks. These defensive yield names have a very high duration, and with that duration have a sensitivity to rates, which means that in any rate hiking environment, these particular names struggle, and regardless of the fundamentals behind the particular equity component of it. The other side of the New Zealand market, which is unique, is that they have a sort of overweight to structural growth names, which have been quite challenged in the sort of the recent past. With the majority of the index having exposure to the sort of long duration or rate sensitive categories, that type of environment that we're currently in doesn't set up well for strong or outsized performance, whereas the ASX 200 sits with about 78% in cyclical names. And when growth or rate sensitive factors sort of derate globally, NZX is disproportionately affected. So this is why New Zealand has struggled over the recent past, while other indices have significantly outperformed. So that leads us sort of onto the funds, and the month of April was positive. The income fund returned 1.1%, with all three sleeves, global equities, Australasian, and fixed income, attributing positively or contributing positively. So much of the performance in the fixed income name was in the credit spread tightening that buoyed investment grade and high yield, although we have rotated out into more mid to short term or short to mid term government bonds. We still had some exposure to credit, and that gave the fund some positive performance in the fixed income space. But global equities, having had a significant rally, contributed positively, with Amazon adding 17 basis points on the back of some Amazon Web Service cloud revenue and better than expected operating income for Q1. Infratil added 12 basis points following a higher independent valuation of their CDC data centers. And the detractors for the month were Abbott's Labs and Boston Scientific. Small detractors, but names that were not linked or related to sort of any of the big growth tech rally that's been going on. Moving on to the Diversified Growth Fund, the fund returned 4.1% for the month. A lot of that obviously coming from our larger global equities exposure. Still some positive performance from the bonds and Aussie equities as well, contributing positively. Broadcom had a significant contribution driven by a series of multi-year AI chip agreements with the likes of Google, Meta, and Anthropic. CVS was another positive contributor for the month, and this was on the back of some regulatory changes that were favorable for the company, as well as a Medicare and Medicaid Advantage rate decision that there would be more spending or there'll be higher rates for those two schemes. And CBS is a major beneficiary of that positioning. The Australasian equity sleeve was positive through names like Infotel, Zero, Wise Tech, SRG Global, Telex, and Macquarie, all for varying reasons. Obviously, the tech names in that space, Telex for new pharmaceutical drugs sort of getting over the line and their pipeline looking strong, and Macquarie's commodity exposure, bringing in some positive revenue numbers. So on the back of that, a good month for both of the funds. Strong growth numbers in global equities, a more challenging environment for fixed income, globally uncertainty on the horizon, and really showing the sort of benefits of a diversified portfolio, and how that can sort of keep in positive performance through varying market cycles and global events. But with that, I just want to say thank you for listening. And as always, if there's any more information you'd like, feel free to get in touch. All the best.